well, Trump says he's going to do these things, so we're assuming some of those things are going to come to fruition. I don't think he can lower the tax brackets and make Social Security non-taxable, and make retirement untaxable, and make tips not taxable, and make overtime not taxable. I don't think he can accomplish all of those because there's going to be too many deficit hawks in there saying this is a problem.
4, 3, 2, 1.
Joined by Mike Kinnett here to kind of make sense of the 2024 election as it's in the books, and Donald Trump will be our next president. And from a tax perspective specifically, what that means for people approaching retirement and really most Americans and what that looks like going forward. The things that jump out to me, what's going to happen with Social Security and what's going to happen with the Trump tax cuts. But you're in the business, you're in the know. What stands out to you post-election results about what the next Trump presidency will look like?
So the really nice thing about my practice, and this is what we preach as we are, as I'm working with impact people, but also how I run my practice in general, is that we tell people all the time, we don't care who gets elected. We have a tax plan that doesn't care whether taxes go up or down because we've already planned and you're already paying the least amount of taxes legally possible, which for a bulk of my clients is zero, or we're already in progress there. So the fact that he won or if he had lost would have been irrelevant to us because we already had a tax strategy in place. But from a tax perspective, I think what's going to end up happening, regardless of who controls the House, we know he's going to control the Senate, probably control the House, but at the end of the day, there's enough senators and congressmen who are deficit hawks that are going to want to negotiate debt ceiling issues or debt issues. So there'll be some constraints there about how much you can actually pass, I think. And I think also there are enough senators and congressmen from high tax states like New Jersey, California, New York, who will want some negotiations done on some of the SALT deductions, right? So I think overall we clearly should see an extension of the existing tax brackets. I don't think that we'll see the sunset. I think that'll be, because he's got all of 25 to get that accomplished. So I think we'll definitely see an extension there. Probably some sort of change to the SALT, state and local income tax deduction. I think that'll be raised, I think. I'm not sure how much it actually helps a lot of people because that standard deduction is still so high, and that'll stay the same. But I will, just as an aside, as an advisor, one of the things that you personally should be doing is they're called SALT workarounds. Almost every state allows it now. But if you have an entity, if you have an S corporation, you can actually have your S corporation pay the tax bill that you would otherwise pay, and it's deducted from your revenue on your corporation, so you get the full deduction. So making up, every year you have to pay the state of California $100,000 of income tax. Well, you put it on your S corporation as a payment. It reduces your income from $1 million worth of revenue to 900 because it's a deduction, but it shows up as a credit on your K1, so you get credit for paying 100,000 to the state of California. If you're not doing that, that's because you aren't working with a proper tax planner. You're working with a CPA who happens to be a historian, and they're not taking advantage of the rules. But so I think for the most part, the tax cuts will remain where they are. If he can get a 15% tax bracket for, cut to 15% for corporate America, I think that'd be a great stimulus. The last time he did the tax cuts, from my perspective, what it did for us more than anything is corporate America did about $3.5 trillion worth of stock buybacks that kept the stock market even higher than it might have otherwise been just based on the profitability of the companies. So I think that's wonderful for the stock market. So I think the consistency is important for the stock market as well. We know kind of the direction we're going to go with Harris, good, bad, or otherwise. Her raising taxes and being unsure about what would actually happen was a little bit more difficult for the market the market's like certainty. It doesn't matter who it is, they just want certainty. So I think that we should see a continuation of it. The estate tax should probably stay where it is now. I don't think they'll lower that back down the way it was supposed to be. But here's the deal for most of us is that we still have another year before everything sunsets anyways. So I would say continue doing the tax plan you were already going to do based upon what we know now, which is what they sunset, because unless the brackets drop, and I don't expect that to happen, unless the brackets drop further, the worst case scenario is to break even proposition for whatever you do in 25, right? That's the worst case scenario, is to break even. Only if tax rates for individuals go down, and then it's only if they go down permanently. Well, this one had that sunset because it required there to be no increase in the debt at the end of 10 years. Well, that clearly didn't happen. So any compromise will probably entail something like that. Again, it's through the reconciliation process. That's how they'll probably make it continue on, the brackets and the tax rates currently. As far as Social Security, what I would tell you is if your clients are paying tax on Social Security, shame the heck on you, because they don't have to. Mm-hmm. That's because you structured their income incorrectly. It's because whatever they designed for their strategies for income purposes was done incorrectly. But I think seniors certainly would like to not have their retirement income, because that's something they're talking about, not taxed in certain Social Security. Again, it goes back to the deficit side of things. We all want lower taxes, and I don't know the exact numbers, so don't quote me here, but roughly 20% of our budget is borrowed money, and roughly 6% is discretionary. I'm not real good at math, but that doesn't work. So if you lower revenue because you're not taxing some of those things, that means we have to borrow more money from somebody. And with higher interest rates, that makes it even more difficult. So I think there's going to be negotiation. But again, the beautiful part, and what we explain to clients all the time, is that the reason why you hire me in the first place, yes, I'm beautiful, yes, I'm brilliant, but my job is to figure out, every time they change the tax rules, my job is to figure out the new solution to those tax rules. And what we do here with people we work with at Impact, and what Impact brings to the table, is that we're always trying to think outside the box. What's the next solution? What's the next plan? Forward thinking, as we talked about earlier. What are we thinking about? How are we going to address it going forward? When they did Secure Act 1.0 and 2.0 and took away the stretch, right? Honestly, I didn't sell a lot of life insurance because I had other alternative approaches to it. Well, now that they've changed the Roth rules on me 3 times in the last, 10 years, not to our advantage, we sell a boatload of life insurance. I mean, a ton of life insurance. And for those of you watching it, it's a no-brainer. If you present this correctly to your clients, every single one of your clients is going to jump aboard. And I say every single one, probably 50% of my clients buy life insurance from us now because it's a tax-free alternative to Roth IRAs. They keep changing the Roth rules on me. Well, we started selling life insurance because they changed the rules. It used to be I could do 3 generations of tax planning with Roths. Well, now I can basically do one. When I pass away, it goes to my spouse. She can use it over her lifetime, but when it goes to my kids, they got to take it all out within 10 years, IRA or otherwise. Well, with life insurance, you can do 3 generations of tax planning again, right? Because it used to be I could give it to my wife would give my kids, and my kids were good stewards with the money. Then it could go to my grandkids. Well, they took that away from me. So I had to come up with a different solution. And that's exactly what these Trump tax cuts are going to be like, is that, the crystal ball isn't so crystal right now. Again, I'm pretty sure they're going to extend the current tax cuts, current tax brackets. It would be nice if you could get tax rates lowered. I'd like to see them take away some of the specialized practices, because people like us in the investment world, we don't get the same 20% discount quite the same way as other industries do. So I'd like to see them fix that a little bit for us. But at the end of the day, I think the conversation you need to have with your clients when they're asking about it is that, look, we have another year before we know exactly what it's going to be. We continue the path that we're taking for whatever tax strategies you've implemented right now. Because again, the tax strategies you using right now are based upon what the brackets are today and what you thought they were going to be in the future, which was going to be higher. So the only way it turns out to be a bad idea is if he is able to lower the individual tax brackets even lower than they are today. And as much as we might like to think that's going to happen, I don't think he can lower the tax brackets and make Social Security non-taxable, and make retirement untaxable, and make tips not taxable, and make overtime not taxable. I don't think he can accomplish all of those because there's going to be too many deficit hawks in there saying this is a problem. That's my opinion, but that's the approach we're taking with clients. We're going to continue the practice the way exactly we're going to do the strategies we're doing right now. Nothing's going to change. By the time we get to the end of 25, we'll have a clearer picture of what's going to happen in the future, and we'll adjust. And again, I've mentioned this before on prior podcasts. We charge our clients a fee every single year. Part of the reason why we charge them that fee, part of the reason why we collect over $300,000 every January just to be our client, is because we are being proactive and we're focusing on this, and we know we're going to have to do the research, and the clients are relying on me to come up with the next solution every time those clowns in Congress change the rules.
Do you use his prior administration in that tenure as like sort of a, not necessarily a compass, but do you look at those previous 4 years to get a better idea of what the next 4 are going to look like?
Well, I think it's a barometer, right? I mean, because we have an indication of what he wants to do. He has said it, and again, good, bad, or otherwise, he has always pretty much done what he said he's going to do. We might disagree about whether we like it or not, but the fact is he tells you what he's going to do, and he said these are the things I want to do. Now, it's the compromise that he's going to have to come to terms with, because again, there's enough senators and enough congressmen who are deficit hawks that are going to want something compromised on that side. There are enough senators and congressmen from high tax states that are going to want something compromised on the itemized deduction side of things. So he's going to have to figure out a compromise of some sort. We don't know what that's going to be today, but we will know what it's going to be by the end of 25, which is where you want to be. But I think the biggest lesson you can take away from his previous administration is he does kind of what he says he's going to do. He's kind of wears it on his sleeve. Again, good, bad, or otherwise.
You've mentioned how you approach this when you're talking with your clients. Is it a flow chart? Is that kind of like if this happens, then we do this kind of thing?
Well, so I guess it's his flow chart, right? I mean, logically, it's a flow chart. That's exactly what it's going to be, because we don't know the answers. I don't know about the rest of you. When I went to stock picking school, they actually gave me a crystal ball. It happened to be the first day I came out of stock picking school. I put the ball on my desk, and it was "Bring your kids to work day." And they grabbed it and dropped it. Now it just says yes, no, maybe. So obviously, right. Obviously, I don't have that crystal ball. Going back to your point before, you base your decisions today on what you know has happened in the past to help inform the direction you want to go today. But it is a flow chart. If this is going to happen, here's the direction we want to go. If this is going to happen, this is the direction we want to go. We had ideas of what we were going to do if Harris became president, because she said she's going to do these things. So if she said she's going to do those things, here's what we were going to do. Well, Trump says he's going to do these things, so we're assuming some of those things are going to come to fruition. And the real hiccup is, how does Congress interact with him on whatever compromises they want to make? So yeah, there is kind of a flow chart. It is kind of if this, then that. I mean, if he makes Social Security not taxable, that makes my life a heck of a lot easier, because right now when we're balancing capital gains, how much we're going to be exposed to capital gains and how much we're going to be exposed to RMDs, I have to take into effect how those two things impact Social Security. If all of a sudden 85% of Social Security is not taxable, boom, that changes these numbers, especially if they increase the standard deduction, right? I mean, that's huge. The opportunities we have, all of a sudden my clients can have exponentially more money income-wise, because we've taken $30,000, $50,000, $75,000 worth of Social Security taxable off the table. And it's even more important if it's not taxable and it's not included in calculations, right? I mean, because it could be one thing where they say it's not taxable, but it's still a calculation to see if these other things are taxable. That's one approach that could happen. But if he just says it's not taxable and it's not even included in the calculation, that's huge. That's a huge win. But I won't know that. So yes, we're contemplating the but what ifs, and some of the conversations are a little bit broader than that, because I don't want to have that specific conversation with a client yet. The conversations I want to have with clients right now is more, look, we know he's going to address these issues. We know there's going to have to be compromise between the senators and the congressmen. And so at the end of the day, we're going to continue the approach we're taking now. It was a strategy that made sense before. It still makes sense now, because these are the tax brackets that we know. When the time comes that he makes the decisions and whatever compromises they come to, and they implement whatever they implement, the reason why you pay me to be here in the first place is so that I can react and come up with solutions to address how he designed the new tax rules, whatever they happen to be.
What's like not the craziest thing, but what would be the most earth-shattering from a Social Security perspective that he would do, or he could do, I guess, would be making it tax-free.
I think that would be huge. I mean, there's this misnomer that Roosevelt said it would never be taxed, and that's not quite what he said. What he said is that the tax code didn't allow for it to be taxed, and obviously Ronald Reagan made 50% of it taxed, and a few years later, Bill Clinton comes around and says, hey, look, if a conservative Republican can make 50% of Social Security taxable, certainly a tax and spend Democrat can make 85% taxable, right? And I know that's politically incorrect, but at the end of the day, that's what happened. And so for him to take that away, to make it 100% tax-free, I think that would be a game changer. I mean, that would be huge, especially, again, if it wasn't part of the calculation for adjusted gross income or for modified adjusted gross income. If it doesn't come into either of those calculations, it's a phenomenal game changer from tax planning perspective. I mean, it's all of a sudden huge. These clients of mine that are making 100, 120,000 a year tax-free now, all of a sudden their income goes up to 150, 175,000. And the ripple effect there is huge because now it gives me more generational planning. Most folks didn't save their money for retirement specifically to leave to their kids, but now that they're taxed even less and have exponentially more income possibilities, it means I have to do less Roth conversions up front, which means less tax for my client up front. It gives me more opportunity to make generational plans so I can pass money on to the kids and the grandkids. It is absolutely a game changer if they make that tax free. This no taxing of overtime, I think that's huge as well. One, the employee is more than willing to work overtime. And two, now the employer is more than happy to have them work overtime because we can be that much more productive. And right now for employers that need the extra work, that hesitate, their productive and what they're producing and sending out product-wise is less because they don't want to pay that extra money. Well, if they can produce more for the same price, it's huge. And the no tax on tips, depending on how he designs that thing. I mean, I was having a conversation last night with some people in our practice group. Heck, half of my employees are going to be tipped employees, based upon the production. We're going to tip them out. It just depends on how he designs that. That could have a phenomenal change to the tax codes. So again, the devil is in the details. I think the most likely thing that we see happen is Social Security because seniors vote. I mean, they're the game changer for elections. They do vote, and Congress and the president both like to appeal to them, that demographic. So I think of all the tax cuts that he's talked about, that's the most likely one to survive. But that would be huge. That would be a huge game changer for our field. But again, we won't know that until it actually happens. And because the clients are already coming to us about tax planning, they're going to stick around even longer. It makes it even stickier because they want to know the solution, because you can't get that answer from H&R Block. You can't get that answer from Liberty or even a CPA is not going to address that thing for them because that's not what they do. They're historians that put numbers on a page.
You can find Mike on the Savvy Investor podcast. Got your own YouTube channel. If you're on Impact's YouTube channel, House Rules can be a great resource, as well as Selling with Stories with Randy Cook, where he goes over the blueprint to having some of those hard conversations as a financial advisor with their clients. Mike, thanks for shining a crystal ball, even though you claim that you broke it. I really appreciate it.
My kids broke it.
Your kids broke it. That's an important distinction. So thank you for taking the time with us and shining a light on some of this.
Thank you for letting me be here.